Hey everyone, me Kevin here. Boy, oh boy, it has been a spectacular last 24 hours, and to help with the last 24 hours, I got myself an emotional support, the closest thing I could get to a Paper Mario, which is paper/foil Mario. So I've got an emotional support animal here. He's got a nose as big as a clown, so I think it's pretty appropriate. Anyway, it's kind of cool because he self-rights himself, so when I throw him, he still stands up, which is kind of cool. He's got little weights on him. Anyway, in this video, we're going to talk about strategies moving forward, because obviously a lot has been made about me selling, and I think folks are tunnel visioning the fact that I'm only selling to set myself up to buy the dip more aggressively. Because, see, I believe the more the market dips, and I do believe that the market has more to dip, the better opportunities I can get. The problem is, when you are restrained by capital in tight markets, you got to do everything you can to maximize your ability to buy the biggest stamp with either options or just straight trades that you can. And that's what we're going to talk about in this video, about how to maximize some of these things. Okay, so let's go ahead and talk about this. We'll also talk about futures, because we've got a little bit of green in futures right now. I'm going to talk about my expectations for futures. So let's go ahead and get right into this. So the first thing that I'm going to talk about is step one, and this is sort of like a 5-part video. Step one is going to be refinancing. Now, what I like to do when markets get tough, because when markets are good, I have a rule: I don't refinance my properties. I generally don't like refinancing at all. And see, in my Stocks and Psychology of Money group and in my real estate investing courses, we always talk about real estate is your piggy bank for a tough market. I've currently built up over $5 million in excess equity over the last 2 years in real estate. Now, I don't try to time interest rates on real estate, although it would have been nice to refinance last year at lower rates. I usually don't even remotely think about refinancing my real estate unless the market's going to crap. And so I've got about $5 million plus, maybe $5.2 million that I could draw out of real estate. And if I do activate those refinances now, I should get that cash by the first week of March, which, if my timing is correct and we end up at peak fear before the first rate liftoff of March 16th, I'll be able to plow an additional $5.2 million into the market, which means I'll be able to take an additional 25% of my overall portfolio, throwing it and throw it into the market at a time that I think will probably have peak fear. In the meantime, between now and then, we're going to have a lot of this vacillation. So I'm not going to get head faked by this vacillation, because we've seen this sort of vacillation for the last 8 weeks. Remember, folks, the most difficult thing in a bear market is raising capital. So cutting away expenses is one thing. Making more money is one thing. But if you have a piggy bank that you can go to and it can bail you out of margin, which I'm not in margin, obviously, at this point, or you can go to a piggy bank so that way you have more money when you need it, close to ideally the bottom of the market, that's ideal. Why do I say this is one of my favorite moves? Because in March, on March 3rd of 2020, I activated a ton of refinances. I refinanced somewhere around 10 properties in the span of 2 months, and I got a boatload of money, somewhere around, at that point, $2 to $3 million. And those original investments, 4 to 5x'd, if not even more. They carried investment returns for a very long period of time. So I want to get max cash that I can for when I think we get to max fear. I don't know if we've hit max fear just yet. I was hoping, and I've been hoping, that we've hit max fear last week, and to some degree, maybe. But I don't know if JPOW is going to help us get rid of any of our fears. So we'll see. But I talked a lot about that on Saturday. Okay, the second thing to do, in my opinion, maximizing credit lines so that way you're not exposed to margin. And see, that's one of the beautiful things about mortgages or credit lines, is they're different. You don't have margin calls on credit lines or mortgages like you do on margin. So I like staying away from that kind of debt or consumer debt and focusing on sorts of credit lines. I think that's really where the juice is. So if you're a business owner or you own your own home, you might consider requesting to expand your lines of credit with banks. Banks are generally quite interested in expanding lending right now. So while not all banks may be accommodative, I believe you'll find one that will be accommodative. So what I would do is I would ask for a home equity line of credit against your home, or a business line of credit against your business income. Home equity lines of credit are known as HELOCs, and certain credit unions, not all of the big banks, will let you pull out up to 80 to 90% of the value against your property. If you find a credit union that lets you go up to 90%, this means if your home is worth $500,000 and you owe $300,000 on it, you could get a credit line while still maintaining your first for $160,000 against your home. That's amazing. Against your business, you could usually get a credit line for somewhere between 10 to 20% of your gross business revenues extended to you as a line of credit. So let's say you're a real estate agent and you make $400,000 gross, you might get a credit line of $40K. Let's say you're, and I know this sounds a little skewed because the profit margin on that might be like 90% on that business, right? But now let's say you're a wholesaler and you have $5 million of gross revenues, but you only net, let's say 4.5 mil, so you're netting 500K on 500 mil, right? They might actually, or on 5 mil, they might actually let you take 10% of that 5 mil or 500K out as a credit line. So like when it comes to these credit lines, they often don't care so much about your profit margin, they care about that gross revenue. So for individuals with gross revenue businesses that are more elevated, those business lines of credits are usually going to be a little bit more desirable. And of course, rates and terms may vary, but these lines are usually variable, and they can take, basically you could take money in and out of them like you can on a credit card, except the interest rate is way lower. It's usually between 3 and 5%. And generally you can take money in and out for the first 10 years. You kind of write a check in and out of it. And then after 10 years, whatever balance you have left is usually locked. The account is closed, and then you're required to pay that off fully amortized over 20 years. That's when you start paying principal and interest. Otherwise, you just pay interest before. So those are some cool things to consider as well. Now, let's also touch now base or on sort of trade strategies, right? And I've been actively working on these and coming up with plans and strategies for these with those close to me. And here's some expectations. So I expect the market to change extremely quickly. In my opinion, all eyes are on the Fed. The first big date is January 25th, and the next big date is March 16th. It really, in my opinion, doesn't matter what news comes out in between, because we could end up having good news and still end up with a hawkish Powell or hawkish Fed board. And I do think that political influence is involved. So we have to be somewhat careful about this. But knowing January 25th and March 16th is just one part of the problem, you've got to have an executable plan to maximize your returns, in my opinion, because if you end up seeing, oh, wow, okay, it seems like we're getting good news from the Fed, what should I do now? And then you have to come up with a plan, you might end up missing the boat. And so you don't want to miss the boat if you're trading. Remember, trading is different from long-run investing, and I think that's so critical. And a lot of people forget that it's okay to trade if you know you're a trader and you're going to pay taxes on those gains. If you want to be a diamond hand hodler, that's totally okay. If you want to divide your portfolio 50-50 or 80-20, you could do that too. But you have your right to change your mind with what you want to do with your portfolio, and nobody should ever tell you otherwise. Now, let's go through this. So I can buy small caps, for example, now with money that originally I had invested in Apple. Because, see, I don't particularly believe the upside for Apple is huge. What's Apple going to do over the next year? 10, 20, 30%? I personally don't think it's going to double. I think it would be lucky to do a 10, 20, 30% over the next year or two. That would be amazing if Apple did that, because I do consider Apple a relatively safe stock. But now, because I sold my Apple stock and I washed some of the gains that I had with Apple with other stocks and I sold profitably, I will be paying taxes. What I can do is I now have this money unlocked to be able to trade without fear of taxes into and out of small caps that, in my opinion, are desperately oversold and are setting up for a short squeeze. These are the traditional ones: the Shift Technologies, the Lemonade, the Tattooed Chef, even the Matterports or the Robinhoods or the Arrival, right? These are great companies that have been so oversold because they just have continued to go down. And so now, because I've liquidated my portfolio in most areas, I have more cash available to be able to take advantage of these swings, because I think some of these small caps have the potential to 4 to 8x their valuations, which is kind of insane and is substantially worth paying taxes on if you can hit this correctly. The problem is getting head faked and getting fake bounces, and we'll talk about that in just a moment. We'll pull this up and I'll talk exactly about what a head fake looks like in the market or a bull trap, and how we're going to try to identify when are we actually really going to turn around in this market. And that's difficult to identify, but we'll do our best to do so. Okay, so some of the things. Obviously on longs, I think it's really good to have buckets of longs. And the buckets of longs that I've been playing in are, of course, EV, where we've got Tesla as a main holder, autonomous tech. Honestly, Tesla is one of the best for autonomous tech. Chips and metaverse, of course, NVIDIA, Matterport, some of our faves, green energy, of course, Enphase. Consumer discretionary, even stocks, and you want to start paying attention to some of these. Home Depot's down 15% from all-time high. Target is all-time highs. Target is down 16.7% from all-time highs. Obviously, your consumer discretionaries like Etsy and Affirm, though you want to be careful with Affirm because if we go into a recession, you want to stay away from Affirm. Consumer staples, well, staples would be more like your probably your Costco's and your Target actually, rather than a discretionary. That depends what you're buying there. But anyway, those are some to pay attention to as well. Maybe even Sherwin-Williams and that. But personally, I still love my faves that I've always loved. Again, the Etsy, Affirm, the Enphase, the Tesla. These are sort of the core ones that I'm strategizing on how to get in. And so there are a few ways that I can set myself up to get into my longs. Obviously, I could just buy the shares on a lower dip. That is an easy option. In addition to just buying the shares on a dip, and this is probably the direction I'm going to go, I can sell puts because I think we've got about a 50-day window here where we're going to be trading downwards and sideways. I don't really think that we're going to have massive rallies that are going to last. I think we're going to have head fake rallies that come and go really, really quickly. And so what I'm looking for are opportunities to potentially sell puts here. So that way I can decrease my cost basis getting into these. And ideally, I want to decrease my cost basis more than the amount of money that I'm paying in taxes. So for example, if on average on my entire portfolio, I'm paying about 20% in taxes or about $4 million, let's just say as an example, washing out gains, losses, then I want to make sure that that's a 20% decline. I want to make sure that I can lower my cost basis in certain stocks, ideally by around 20%. And if I could do that with weekly sell puts, farming the credits, that might be an option over the next 50 days. Probably the worst thing I could do is just sit for 50 days and do nothing with my cash, though, that's TBD. So still working out the exact details of that. Obviously, every single move that I make, I will be pointing out in my Stocks and Psychology of Money group, whether it's crypto or it is a traditional stock or it's an option. Every single trade goes in the Stocks and Psychology of Money course. So if you're looking for trade ideas, again, no guarantees, ups or downs, but I'm going to be doing a lot of trading over the next 50 days. I will probably be doing more trading over the next 50 days than I have in the last year. So if you like trading, check it out. I stare at the charts all day long. That's what I do. Now, some of you may be unfamiliar with exactly how a sold put works, so let me just give you a very quick example using Enphase. So let's go ahead and jump in here. We're going to drop in Enphase. What we're going to do is we're going to see this has gone down substantially in value. We're going to jump over here to options. You could go for weeklies, which can sometimes give you a little bit of a higher rate of return, but let's just go ahead and say I'm going to go for a 33-day on this one. I'm going to go for 33 days, and let's say I'm willing to buy Enphase. And it's currently at $126, so we go for the 125. Let's say I can sell this for $12 a contract, approximately this year, or per share, that is, since contract is times 100. So here's what's going to happen. I'm going to pick the 125 strike, February 25th, 2022 expiration, sell put. And this is if you're using a platform that has the like to open or to close phrase, what you're looking for is sell to open, because by selling a put, you're giving somebody else the right to force you to buy shares at $125. So in this case, I'm giving somebody else the right to force me to buy 10 times 100 shares of Enphase at $125. That means I'm agreeing to pay $125,000 for 1,000 shares of Enphase. In return, I'm going to get a $10,750 credit. Now, if Enphase trades above $125, I can either sell the contract for a profit, or I can sell, I could literally do nothing. I could keep the $10,000 credit, and then the contract expires worthless, and then I keep the $10,750. The only time this is bad is when prices go down. You go under 125. Well, I'm good until about $115. That's approximately my break even, depending on if I get it for $10, $10.75, somewhere around there. My break even is going to be somewhere around $115, $114. That's my break even. So it's kind of like I'm buying Enphase for a discount. And the cool thing about that is if it ends up falling to 120 and I get assigned, that's okay, because it's really like I got the shares for $114 or $115. And I got forced to pick them up while it was at about $120. Big deal. So I'm still in the money in that case. Gets ugly, though, when you sell a put and Enphase goes from 125 to like 80. In that case, you'd be agreeing to buy shares for 125. Sure, you'd have the $11-ish credit, but you'd still be upside down by $34. So there is some risk related to this. And that's why sometimes what people like to do is they like to go for the 1 weeks. So that way they limit how extremely down it could go, but they're still farming that credit. Because look at this, on 1 week, I'm collecting $4,650. If I go to 4 weeks, I'm collecting roughly twice that. So it's 4 times the time for only twice the credit. So that's why those weeklies can be really nice, because people are buying weekly puts, speculating. So it's kind of like selling the pickaxe to the gold farmers, right? Now, if I went in here and did 500 of these contracts times 100 shares per contract at, in this case, per the week, $4.65, I would get a credit of $232,000 between now and Friday. And if Enphase sold below 125 by Friday, I would be committing to spend a few $1 million, $6.2 million, which is a lot. It's crazy, right? I'm using big numbers here just as an example. But still, if Enphase traded above 125, I could take that $230,000, thank you very much, for free by Friday, as long as we're above 125. So these are just some ideas. That's not exactly what I'm planning on doing. This particular one, I'd probably go a little to different prices and ladder and vertical this out a little bit, but to be determined. Still in the works. Just a quick example. So now, what about shorts? Okay, so I don't love shorting, because I believe when you short, you're betting against Train America. You're betting against the future growth of America. So what I'm looking at is potentially shorting overvalued momentum, which is very, very dangerous. You could lose your pants on that, so you gotta be very, very careful, or kind of limit your exposure here. Or specific tech stocks that have not fully sold off yet. I specifically want to do this as potentially an earnings play on only certain stocks. I hate playing earnings, but earnings are going to be the catalyst on very specific stocks where I believe I have a competitive advantage. So for example, let's say I'm a consumer or a purchaser of a certain good, and I see something shady happening at a company, and I think it's going to get reported in earnings, and it's corroborated by potentially still a high stock price. That might be an opportunity for me to short. Who knows? But in my opinion, what you're trying to do with trading is balance the scale to where you have an 80% chance of being right, 78% chance of being right, 30% chance of being wrong. In that way, you are right more than you're wrong. If I had those odds in roulette, I would be playing roulette all day long, and we would be doing roulette live streams every single day. So one of them just, and I've got a whole list of positions. I've got about 5 that I'm really considering it right now. One that I will just kind of throw out there, and I have not made any moves on this one yet. It's very, very dangerous, but I think if we get more pain in the market, it's going to be very, very juicy for short potentials. It's DWAC. I know that sounds like anti-Trump. This is not a political move at all. This is just straight up like, okay, there's absolutely zero reason a company with its level of development, and I know they've done some fundraising, they've done some good with fundraising, but with this level of development should be trading for what it's trading for. It's absolutely insane. Calculating the valuations on SPACs is a little bit more complicated. You can't just look at what the market cap is on Google, because that's based on the market cap of only the PIPE shares. Anyway, long story short, this is like a $10+ billion company. DWAC is worth more than like Robinhood, which, I mean, maybe some people might actually be happy about, but from a rational basis, with a company where Robinhood's got $7 to $8 billion in the bank, and DWAC is worth more than Robinhood, it doesn't make logical sense, right? We're going back to fundamentals here. But anyway, okay, so any trades that I do end up making, obviously I will post immediately in the Stocks and Psychology of Money group. There are some trades that I may make a video about and then post them like a day later or whatever. I can't always post them the same day though, because it takes time to put videos together, and I do my best to get polished videos out. Even though I can get news videos out very quickly, when they come to my thoughts and putting my thoughts together alone, I try to make sure I bring out a polished product. Okay, so next thing I'm going to also do a lot is my expectation is crypto is going to be extremely volatile over the next 60 days. And I do think that there are going to be trading opportunities in crypto where we are going to bounce up and down and break through and break above over and over and over again, support lines within the crypto space. And so I want to take advantage of those opportunities when I see them present. Probably going to stick with some of the larger ones, and that's going to be like Bitcoin, Ethereum, and Cardano, maybe even Solana, just because these are ones where I feel like I've got the chart down a little bit better than some of the others, though I'll probably be expanding to alts as well. So I do expect to get into and out of crypto on almost a daily basis over the next 50 to 60 days, and we'll see how it goes. It'll be fun. Okay, the next thing that I'm going to do is I'm going to Brokerage Transfer. So I'm really tired of using JPM. I can't handle the fact that they don't let me do pre or post market trading. I have to wait hours for my margin to become available when I want to use it. Sometimes I have to call them to buy or sell, and I can obviously only do that when they answer the phone. And if the amount is over a certain size, then they can't help me trade, and the bank automatically has some weird limit set, so then they have to, like, the phone banker has to send an email to a different department, but everybody's work from home, so it's like this complete cluster F. I absolutely hate it. Complete moronic rules. And rules like this have cost me tens of thousands of dollars in lost opportunities, because when I make a trade and it goes down, like, I'll suck it up. Like, okay, I made a mistake. That's fine. If I make a trade and I'm like, I want to make this trade like right now, let's go, and I can't do it because somebody else is standing my way, like Vlad, then I get pissed. That's not fair, right? That should happen to nobody, and my heart goes out empathetically to the Robinhood folks who had this issue. Also, TD Ameritrade is expecting to offer me some sort of special portfolio, like lower margin rate, which would be really amazing. JPM's was like 1.25, and if they can get lower than that, let's go. Okay, good. So now, what else? What else? So the big thing here is I am going to do everything that I can over the next 50 to 60 days to make sure that I can get more money raised so that when we get better pricing, I am the person there buying. I'm a big fan of buy the dip. I just want to do everything I can to build my portfolio as much as I can with trades, probably by yield farming credits, because I think that's the safest and most conservative way to do that. And then that way, if I've got a few extra $1 million, I've covered my taxes, boom, I get back in at lower prices. So that's my expectation. Watching futures very closely. So futures are really interesting right now. NASDAQ futures have shot up from about 0.66 to about 0.94. They ran up to almost 1% up in futures. They pulled right back down to up about 2/3. So you're seeing that volatility already present in the futures market. Here's my expectation for tomorrow. I believe that there's a very high likelihood that we're going to have a green open tomorrow, but I think it's going to be a little bit of a weenie baby open where it's kind of just like, yay, we open green, but then the second half of the day, the traders take advantage of us, the institutions take advantage of us, and we sell out. I do think if you are a trader, this is a very, very important pattern that has been consistent for the last 8 weeks that you can take advantage of. Also, remember, the best time to sell puts is when put prices are higher. So if you do, towards the second half of the day, start seeing prices go back down, that's probably going to be the time to sell your puts rather than the beginning part of the day where stocks are green, because that's when puts are going to be less expensive. And if you're going to sell them, you want to sell when things are a little bit more expensive. When stock prices start falling, your put prices, the credits you're going to get, are going to start going up, which is better. Keep in mind, we're also seeing volatility go down. So there might be plays on UVXY as an example. So this is a little tricky, but just so you know, UVXY is essentially a ticker that goes up when volatility goes up. So when volatility goes up, you can actually make a bet on this by having call options or just buying the actual ticker, right? You have to be careful. It's not a one-for-one correlation with volatility. So you got to be careful with that a little bit. Maybe do some research on the actual ticker beyond what we're going to talk about here in this video. But there's also the inverse of this, but I personally prefer just take the UVXY. And if you think this is going to go down, like it probably will first thing in the morning tomorrow. In fact, right now we're expecting this to open up down 3%. Futures are going to open up down 3%. At least that's what futures indicate right now. This isn't actually active right now yet. Then this should also go down, we'll see roughly 3%, sometimes a little bit more. And there's an opportunity then, if you believe that volatility is going to go back up second half of the day, to maybe make a bet on this particular one. This is to me like a perfect day in, day out kind of trader stock. So that's definitely one to watch. Okay, good. So those are my thoughts. Folks, thank you so very much for watching. Check out the programs link down below in Building Your Wealth. There's a coupon code that expires on my birthday, which is in 5 days. You get 100% transparency as soon as I make trades. And folks, we'll see you in the next one. Thanks so much. Goodbye.